to the Edge Live discussion. It is November 6th, and I'm Tim Quast, and along with me, as usual, is Brian Wilson, market strategist. So I'm going to jump right into this. I have, four things that I wanted to talk about today. I'll do the easiest thing first, and then I'll get to this question that Martin posed by email, which is, what about the effect of earnings on the model portfolios? Because clearly there's been a lot of volatility. So I'll come to that. But let me share my screen really quickly here and come to this first item, which is, this is super easy, but I talk about it all the time. So if it's redundant, and for you veterans, this is repetitive, but I wanted to come to how to very quickly track these mega caps. It's 120, dropped to 128. I think it's helpful, not like it's any, awesome different directional signal. I mean, if you look at the demand supply balance there and you go look at the broad market, you look at the tech sector, I'm just scrolling down here. You look at this, it's almost identical, which we will talk about too. But I think because it's so much of the market, you can get some pretty good reads from this. So it's very easy to create it. There's one criteria. So it's, you filter for market cap equal to mega cap. That's it. But it's startling how much market cap ties to this list. And so I think it's helpful because I could go get a read of volatility this way. It's, you could go in here, let me go back in. I shouldn't have exited. You can sort it by all kinds of, all of these you could sort by so that you could get a pretty good read on, what's the demand supply trend in the group, what's volatility, which is what I was going to click on. If you look at the volatility of this group, you can download this data and run an average on it. You might just spot check that. And if that group becomes volatile, probably the market will. Not that volatility is a leading indicator. It is an important thing. We say we trade demand, supply, and volatility because volatility tells you, what kind of returns you might get. You're after a piece of that depends on a demand supply imbalance. Not more complicated than that, which is good. But it's a helpful read. So that's how to do it. And just that it's a dynamic portfolio that just looks for that and will tell you every day. If money's coming into the market, we tend to get more mega caps. If money starts to leave, that number stagnates and begins to fade because the money is necessarily biased towards size. And it's getting more complicated. What we discussed last week. Thank you for Steve Hicks. I think I saw that you might be here. And maybe Austin, maybe Forrest as well. So if you both are, good to see you both. Is that these, the changes to round lots are going to fragment order flow and do what the institutions call, they get partial fills, meaning that you've got orders in the marketplace and you can't get all that you're after. And it has to do with the instability of prices and the small trade size. And so, what is the definition of volatility? Changing prices. So we will watch those things. I think it's an important thing to know. Then, okay, so Martin, to your point, to summarize the question, it is, what do we do about, should the model portfolios, so the focused momentum and low volatility portfolios, and I won't step on your toes, Brian, you're going to talk about that a little bit. Look, they've been great performers. They gave us an indicator, though, right, Dave? I mean, that was a pretty good leading indicator. I thought you could look at it and go, well, momentum deteriorated. Is that a signal? Well, probably. When we saw that the standard deviation began to deteriorate, we thought, oh, that was a pretty good signal now to be aware that if the broad sentiment, the demand supply equation in the market begins to change, rather than just writing that out, we might not write it out, particularly if it's options expirations and earnings season, and we have broad sentiment that has topped. I'll come to that a little bit more. But how would we do that? That's the thing. The answer to the question is, should we sit out of the model portfolios around earnings? Well, in the preceding 2 quarters, it was not an issue. And why was that? Well, you can look at the performance of the portfolios and say there was a lot of money coming into the market. And so both portfolios performed very well. And the bad stuff during earnings sort of balanced out the good stuff, and it didn't have any material effect. You can look at the graphs in those model portfolios and see that earnings didn't seem to have any particular bearing on the outcome. But I think when there is a broader change that is occurring, maybe it does. Now, I have chosen, and Brian and I both try to be pretty clear about what we're doing. If we think that the conditions warrant staying on the sidelines, we don't give advice. We just provide data, and we'll make our observations about it. But, my observation has been, I want to see this bottom. First I wanted to get through options expirations, because I thought, well, it could be rocky. Wasn't bad. In fact, the market, was reasonably healthy there. But it's difficult in that environment for me to commit long exposure to the market when I know that the conditions aren't great. Even to yesterday, I observed that don't be fooled by that. That is just mean reversion. That's how the market works. It has a tendency to mean revert. If the mean reversions begin to lose momentum, like they did, like happened yesterday, if it's up 1%, that's all of the market's volatility. There's a very high probability the market will be down some the following day. But it's still mean reversion behavior. When it fades and loses half of those gains in the same day, that's not a good sign, right? That's telling us that there's a bias that is beginning to deteriorate the midpoint pricing in the market, something we look at. It's behind the scenes. I look to you. How you measure whether there's money coming and going, in large part, is how it performs relative to the midpoint price. And it's interesting. If you take the whole data set for SPY, if you were to look at this, I did a quick check of this before this session, and I looked at SPY back from 2021 forward, and believe it or not, it averages 4 basis points. That's it relative to midpoint. Why? Because it's the benchmark, right? So it's gonna mean revert. But if that deteriorates, that's a signal, right? And I have to think about, is there something in there that we can make use of? It does not change what we already know to be true in the data, which is this, that a decline in the supply side will produce a gain. So that's what, if demand is steady the whole way and we have insufficient supply, there will be a consequence from that. If supply increases and demand stays the same, there will be a consequence from that. And there has been. Those things will almost always be true. The exceptions would be options expirations, exogenous events, Fed meetings, those things could change the outcome. But even then, we will have a pretty good signal in the data about what's occurring. This is it's a confirmation that actually deteriorated in the last 10 days to 0. Well, if there's no spread, I've said this before, if there's no return, if the average of the midpoint is there's no gain, what will happen to the market? Well, in a market where the bid is always lower than the offer, it will decline. It's just a mathematical fact. And these are things to me that one has to think about because they reflect the way the market works. It's not what you hear from everybody else, who will talk about fundamentals and, how stocks performing relative to earnings expectations. How many companies are beating, are surprising or beating to the upside versus the downside. Those factors drive less than 10% of volume. What about the other 90%? It's mathematical. And so that's why I return to it. Okay.
Hey Tim,
Let me,
do you mind repeating
yeah,
what you just mentioned about midpoint pricing for SPY and perhaps give us an example of what that looks like?
yeah, I don't know if I can. I don't have it up at the moment. So
Or
I
just
have
the
it
or
on this
just what a
other
couple of the
machine.
numbers looked like. Yeah.
Yeah, so I can't pull it up. I can show you what we do behind, I mean, I can describe what we do behind the scenes. So you could, the market there has different readings of midpoint. We're just taking a pure midpoint. There's a high price, there's a low price, and you could take the average of those. What is that? And how much, and does the price where the does the closing price, the reference price, how does it comport with that? Well, over the long run, it's a little higher than that, right? That's how you get a rising market. So when that begins to deteriorate, well, certainly it's going to show up in these other signals, but that can tell us something. Now, it's not, I would be very careful of using that without understanding demand and supply because you will get fooled. But in context of demand and supply, if we're looking at demand and supply and that tiny little margin above where a stock price is closing, like okay, let's say the midpoint of the day is $20 and a stock is consistently closing at 20.01. Well, clearly that's a spread versus it's a tiny little spread versus the midpoint price, but it would tell you that money is coming into the market, all other things being equal. Now, you can be fooled. Machines do. Look at AMD. We can look at the data for AMD and go, well, it's probably going to decline. Yet it was up yesterday. But it's machines. That's just machines fooling people. And it's why you don't want to chase that. The data and go, well, that's not good. Then you have to be careful. Demand's declining, supply is rising. Probably don't want to chase that price. Not always true, but that's what we're talking about. As that deteriorates, it's a great way to understand in context, demand supply volatility. We're going to look at all that stuff, and that's how we model. It's part of our algorithm. This algorithm that we call market structure sentiment or demand includes that as a data point. It's in there. And so we look at that stuff. Last thing for me, and then maybe we do our little Q&A and then I'll hand it off to Brian, is what's next. And Brian, you and I can collaborate on this. Um, let me tie this in. Why did I think that there would be additional volatility? Because the when we break the 1, 2, 3 rule, so where the broad measure moves 1%, the basket moves 2, momentum moves 3. All of a sudden, the broad market hit 3 on October 10. That's a canary. Now you begin to very carefully look at demand and supply through the market. Are there tells in there? Well, you could go back here. This is where it happened. Call it, what was it, October 10, right? What has happened since then? Well, supply rose, demand bottom, demand top, demand sliding again. You'd say, well, yeah, but the supply side sliding. I'm looking at mega caps because they're 75% of market. That's not healthy. This by itself doesn't tell us anything particularly good. All it tells us is that demand has weakened, and all of a sudden, the people who supply liquidity are not doing it. They've covered their short exposure. It's not that that money is betting on downside. It is that the conditions that cause market makers, the citadels of the world, to do what they do, it's really deteriorated. And you could look, I would go look at mega caps. Okay, then I'm immediately going to go look at the tech sector, right? And say, well, if that's a lot of the market, what does it look like? Same thing. I'd look at that and say, when they're both moving the same direction, that is not good. You'd say, don't you short the convergence? Yeah, it's difficult. You could get hurt. That's not telling you to short it. Prices really bounce when markets deteriorate. They don't just, you know, if you're going to short something, you want a higher probability that it's going to consistently decline. You don't want something that declines 2% and then goes up 3%, and now you're forced to cover. But these are conditions that tell us the market has destabilized. Now, I don't know. It might restabilize. But those are important things. If you were to ask me, what is the tell? What is the core thing one looks for? Why would I get concerned about the market? There you have it. You have a canary in the coal mine where we bust the 1, 2, 3 rule. And now we look at the demand supply balance and it's not great. Those things are very cautionary to me. So I will stop there, Brian. Over to you.
Sounds good, Tim. Thank you. And I know you've got to take off, so I can stop the
Oh,
recording when I finish, or you gonna
okay.
stick around for a minute?
I should go prepare. I prefer
Okay.
this. This is more fun. but
Right,
but
exactly.
yes, carry on, and I will be, yeah, I will see you. I will see you next week. I'll certainly be here. So I'll
Okay.
see you then. Thank you,
See you
Brian.
later. See you later, Tim. Yep. I've got a couple of topics today, and then I'll, move into my what's ahead as well. I'm going to start off with what I discussed earlier today on Market Desk Note. This is what I call big tech above eight, and let me show you what this looks like before I get to the spreadsheet. I talked about this topic last week. So big tech sentiment. So when we talk about sentiment, we're talking about demand in the marketplace. And specifically here, we're talking about demand for the top eight components of the triple Q, AMD, Netflix, and Shopify. And is there anything magical about above eight? It's just something that I noticed when I was looking at the data over time. And you can see that sentiment got all the way up to eight, starting to retreat just a little bit, and it's actually gone back down below eight now. So what has happened over time when big tech does get a little bit stretched? And that's kind of the way I think about it. You can see from the time that big tech gets above eight until it goes below it, we tend to average about 4 trading days. This is data looking back at the last couple of years. You can see that market returns are generally not that great. On average, we're down about 50 basis points during those 4 trading days. But to me, here's the kicker. When we look at it afterwards, and please take the data for what it's worth, it's just 2 years of data. But when we look at it afterwards, the market's actually higher. So we don't tend to implode. We do tend to have a period of weakness, and then that weakness tends to get bought. Of course, that's been the general consensus here over the last couple of years. If you look at broad market sentiment during all of these periods where big tech has been above eight, it's been pretty strong. And that was the case as well. This last one was back in August. So I just wanted to show you what that looked like, and that's where we're at right now. We're in those periods. In one of those periods, I mentioned it, I think last Friday, I mentioned it Monday, and I mentioned it again today as well. And we're starting to see that deterioration in the market. Um, one thing from a big picture perspective, and I just started to look at this recently, so I don't know if I have a lot of data points to give you, but what I noticed as I was preparing for today's meeting, I should back this up a little bit farther. So this is what I noticed right here is that we're not hitting above the red line with regularity anymore. The red line is sentiment. That is six. Think of it as just strong demand, driving sentiment higher. And let me take this look back a little bit farther to give you a better view. So you can see the bull market of 23, the bull market of 24. What do we notice with regularity? Well, we notice that, we do get above the red line with quite frequently. In fact, during 24, it happened basically all the time. What do we notice now? That overall trend is starting to weaken a little bit. Is that pointing to perhaps just weaker overall demand? It could certainly be the case. Let's bring this back to a year. But you can see that like if you drew an arrow, that arrow right now is going lower. Now, could that change? Absolutely. But I think we can see pretty clearly that, this recent demand is certainly not as strong as what we were seeing with regularity in 23 and 24. So it's just something, it's a data point, that perhaps we just keep an eye on, and let's see if that changes. Tim did mention I was going to bring up the edge focus portfolio and the low volatility portfolio. They're basically identical right now. This is the edge focus portfolio. Look at the components. It's essentially big tech, and you toss JP Morgan in there. You look at low volatility portfolio. Here's the current components. It's basically big tech with tossing Eli Lilly in there. So we're having the portfolios are having a hard time finding other components. To me, that's a little bit of a warning signal as well. I like Tim, I'm not doing anything in the portfolios right now. I'm waiting for conditions to stabilize. And as we look at the path ahead for the market, similar to Tim, I'm looking for a little bit of stabilization. Right now, you can see that broad market sentiment has hit 5.2. Let me take you behind the scenes for a second here. I'll show you what the daily read is doing. This is the daily read. Every day, this is a 5-day average, what you're seeing in terms of sentiment. And you can see that daily read, it's moving down 4/10 of a point every day right now. You can see today that's going to get down below neutral. Does that continue to rapidly deteriorate? I don't know. Certainly right now, I would say, I would say it is. We'll have to see what the data actually supports. But what we also know is that if big tech stays strong, then it tends to support the market. Right now, big tech is strong. That also can rapidly deteriorate. Just because it's 7.9 right now doesn't mean it can't be below 5 in about 2 or 3 trading days. So just be aware of those conditions. To me, I'm seeing, like Tim, I'm seeing risk in the short term until demand does start to stabilize. See if I've missed any question. Question from Candace, how does the current possibility of the AI bubble and tech factor into the market not spending much time above the red line? I mean, it's a great question, Candace. And you know, when have when have we actually entered the bubble? Hard to say. Everyone has different opinions about that. Some would say that AI spending has been continued to be strong. And if that's the case, though, and if AI was really continuing to lift the market, why is demand not getting above the red line anymore? This for those who are familiar, this was one of the longest periods that we had a bit above the red line. Of course, we were coming out of all the April tariff drama. The market was oversold, money came flooding back in, and we've had other periods above it, but that's definitely a period where it's been weakening. And if anything, during the last 3 months or so, AI spending has continued to be rampant. So if we're continuing to get that AI spending, especially in the big tech components, but that's no longer lifting demand above the red line to the same degree, I think that is a little bit of a risk. I didn't really unpack it, to be honest with you, until about 20 minutes before the meeting, but you can see that, demand is weakening over time. That was really what I had for you guys today. Does anyone have any further questions? Any words of wisdom for us? Candace, any words of wisdom? Candace always has wonderful questions. We really appreciate her. Well, everyone, I'll just thank you for your attention today. Once again, we're in a little bit of a transition right now. beginning of a month. It's obvious that we call it new month, new money. It's obvious that that new month, new money is not as strong as perhaps it should be. So for me and Tim, we're waiting for a little bit of stabilization, and we'll see how that plays out here over the next week. As always, thank you so much for your time today. We really appreciate it. And if you do have any questions, please feel free, to send us an email. Hope you have a great rest of the day.